Welcome to World Vision. A recent report from the U.S. Wall Street Journal has sparked concerns regarding the growing global influence of the yuan. Seizing the opportunity presented during negotiations with Saudi Arabia and Israel, the U.S. has subtly urged Saudi Arabia to distance itself from China. This request included a stipulation that Saudi Arabia refrains from utilizing the RMB as the currency for settling oil transactions. Insights from U.S. officials involved in the negotiations have been reported by U.S. media. The United States, along with Saudi Arabia and Israel, is engaged in tripartite discussions under U.S. leadership, gradually moving closer to an agreement. Unexpectedly, the U.S. has introduced further prerequisites to Saudi Arabia, insisting on the exclusion of the yuan as a settlement currency for oil trading. In essence, it is the growing international prominence of the yuan that has sparked apprehension within the United States. China's unwavering commitment to a stable foreign policy and a domestically harmonious political climate has significantly bolstered the process of internationalizing the RMB. This forms the bedrock for gaining the trust and acknowledgement of foreign investors in the global market for the RMB. Given China's role as the world's foremost trading nation in terms of goods, the utilization of the RMB is organically expanding through continuous promotion efforts. Additionally, the pivotal factor influencing the global acceptance of the RMB lies in the currency's stability, an attribute well supported by China's substantial foreign exchange and abundant gold reserves. This contrasts sharply with the trajectory of the US dollar, which, having relinquished the gold standard, operates without restraints, leading to the accrual of mounting U.S. debt. This very fact has propelled the worldwide trend of de-dollarization. Given its stature as one of the planet's largest consumers of oil, China's demand for oil resources remains robust. Historically, oil imports were settled in dollars, a practice that not only confined our currency's status but also introduced heightened exchange rate volatility and the potential for external interference. Another significant advantage lies in settling oil transactions using RMB, which serves to mitigate risk and cut down on expenses. Opting for U.S. dollars as the settlement currency exposes businesses to exchange rate volatility and potential external interference, introducing an element of uncertainty into China's oil import operations. However, choosing RMB settlement can effectively sidestep the hazards tied to fluctuations in the dollar's value and diminish the adverse impact of exchange rate uncertainties on import expenditures. Furthermore, RMB settlement also holds the potential to curtail costs associated with currency conversion, thereby enhancing trade efficiency and bolstering overall profitability. Simultaneously, the adoption of RMB as the settlement currency for oil transactions presents a mutually beneficial opportunity for both China and Saudi Arabia. Saudi Arabia has long desired to break free from the reliance on dollar-based settlements and reduce its dependence on the dollar. Collaborating with China on RMB-based oil settlements allows Saudi Arabia to diversify its currency options for settlements, thereby minimizing exchange rate risks and external intervention. This move not only expands the scope of currency settlements, but also fosters increased trade cooperation and economic ties with China, driving the mutual development of both parties. It is important to recognize that the core aim of the United States is not to outright prohibit the usage of RMB, but rather to uphold the dollar-centric oil trading system. The U.S. mandates that Saudi Arabia's oil trade must be conducted exclusively in dollars, emphasizing the necessity of employing the dollar for trade transactions rather than opting for the yuan. In earlier times, the United States had consistently secured the employment of the U.S. dollar in oil trading, achieved through collaboration with significant oil producer Saudi Arabia. However, a notable shift is now underway, as an increasing number of countries, including Russia, Iran, and Saudi Arabia, opt for non-dollar currencies in their oil transactions. This shift poses substantial challenges to the prevailing dollar-dominated oil trading framework. This evolving trend carries the potential to disrupt the unassailable status of the dollar and wield a substantial influence over both the economic and geopolitical concerns of the United States. Should each nation choose to utilize its own national currency for oil trading, the resulting reduced demand for the dollar could engender a depreciation of the currency. This depreciation, in turn, could negatively impact inflation and the overall economic stability of the United States. Furthermore, the erosion of the dollar's dominance within the oil trade realm would correspondingly erode the United States' sway within the global financial system. The potential collapse of the dollar-centric oil trading structure could thus have profound ramifications for the geopolitical interests of the United States. The United States has been able to wield significant influence on the global stage by virtue of its control over oil trade. The potential loss of this control could result in a weakening of the U.S.'s standing in the geopolitical arena, possibly leading to challenges to its current position. As economic losses within the U.S. continue to mount, countries are actively responding by reducing their dependence on the dollar, giving rise to an emerging trend known as de-dollarization aimed at circumventing dollar dominance. Many nations are diversifying their trade currencies, entering into bilateral or multilateral currency swap agreements, actively fostering the internationalization of their own currencies, and diminishing dollar reserves. This concerted effort aims to curtail the proportion of dollar usage. Particularly, countries in the Southern Hemisphere are prominently engaged in this movement, actively reducing their dollar reserves, conducting cross-border transactions in non-dollar currencies, and exploring the establishment of fresh multilateral settlement mechanisms. Amid this shift towards de-dollarization, the prominence of the renminbi has risen. On August 17th, India and the UAE embarked on a path of settling energy transactions in rupees and dirhams through a mechanism known as the local currency settlement. This approach witnessed its inaugural oil purchase on the 14th, signifying a movement towards lessening reliance on the dollar in favor of local currencies. The Indian Oil Corporation made payment to the Abu Dhabi National Oil Company in rupees for the purchase of 1 million barrels of crude oil from the Middle Eastern nation. This transaction was confirmed through a statement issued by the Indian Embassy in the UAE. Notably, this deal follows a prior occurrence in which a UAE exporter sold 25 kilograms of gold to an Indian buyer for an amount of around 128 million rupees, $1.5 million in July of the same year. The local currency settlement mechanism was a notable component of a historic memorandum of understanding inked on July 15 during the one-day visit of Indian Prime Minister Narendra Modi to the UAE. This agreement also encompassed the mutual commitment to interlink their instant payment systems. Anticipated to yield reduced transaction expenses, local currency settlements negate the necessity for dollar conversions and enhance reliance on domestic currency. As per the accord between the parties involved, traders gain the flexibility to select the currency of payment. This development in India-UAE oil dealings aligns with the broader global trend of de-dollarization, marking a point in time when such tendencies are on the rise. In the contemporary landscape, the world's confidence in the U.S. dollar is in decline, leading to an increasing number of countries contemplating a departure from its usage. This trend, marked by a growing inclination to forsake the dollar, is gaining momentum. Janet Yellen, as acknowledged, has noted the global decrease in dollar reserves. This isn't merely a superficial shift, rather, it is rooted in a lack of trust in the dollar and apprehensions regarding the U.S. financial system. Russia, in particular, has felt the brunt of Western sanctions due to the Ukraine crisis. Confronting this pressure, Russia has swiftly embarked on a sequence of measures to diminish its reliance on the dollar. Within the realm of energy trading, Russia has chosen to cast aside the dollar in favor of its own currency and other alternatives. This strategic move has proven to be an effective measure in alleviating the dollar's impact on the Russian economy.